This is the Norris Group's Real Estate Investor Radio Show, the award-winning show dedicated to thought leaders shaping the real estate industry and local experts revealing their insider tips to succeed in an ever-changing real estate market. Hosted by author, investor, and hard money lender, Bruce Norris.
Hi, thanks for joining us. My name is Bruce Norris, and today we are joined by three special guests who have been with us many times. Kaaren Hall, CEO of uDirect IRA Services. At uDirect IRA Services, the investments in clients' retirement accounts can be self-directed by the client directly. With a self-directed IRA from uDirect, you make the investment choices. The types of investments are almost limitless. With a self-directed IRA account, uDirect acts simply as an independent administrator, handling the investment transactions which you dictate. Occasionally, he says you can't do that, but that's okay. And then we have Matt MacFarland and Amanda Hahn, managing directors of Keystone CPA. Keystone is a professional client service firm dedicated to providing comprehensive financial, tax, and accounting solutions to business owners and real estate investors. Their team of certified public accountants deliver high-quality financial solutions through a high-touch, high-services approach to ensure that their clients maximize the profitability of their businesses and investments. Keystone financial and tax strategies result in increased profitability and wealth accumulation for all of their clients. So we welcome you both to, or all of you back again. And certainly nothing is boring about what's about to occur. And I almost don't know where to start. And I think, I'll ask both of you. The changes are being discussed. Have any of those been actually implemented, or is this just still up to Congress to vote on all this stuff? Kaaren, why don't you take the first layer of anything to do with, the world that you deal with?
Sure. On my side, there are proposals. On my side, it's the House Ways and Means Committee that on September 13th submitted proposals that the House and the Senate will look at.
Okay, September 13th is passed. I mean, that date. So what did they do?
The House Ways and Means Committee released their proposal to the House and Senate. They released a bill for the House and Senate to consider.
And that is going to it's being considered now?
It is. And so it will, I think we're going to have the whole thing wrapped up by the time that Congress adjourns on December 10th.
December 10th. Okay. All
and
right.
I think they were supposed to, all of the tax changes that we're looking at and talking about is part of that same proposal that Kaaren is referring to. I was reading that there was supposed to be a vote, or I guess a preliminary vote this past Monday on September 27th. That didn't occur. So the next goal is they were supposed to have some sort of preliminary voting on Thursday of this week. To see, to get a feel for where people are. But my understanding is there's still, even though the proposal's out, there's still a lot that they're working through. There's not a whole lot of agreement in what's in the proposal. So to answer your question, no, nothing has been passed. These are the preliminary proposals, and any and all things can change between now and the time anything is finally signed into law.
For both of you, I guess the first question is any of this retroactive to January 1st? Which is a very scary thought.
That's such a good question. It's, I think some of it actually, they specify that it's going to be effective starting next year. Some of it, like there's potential changes in capital gains rates. They want to make it effective September 13th because I guess
that was the date the House.
Yeah, that was the date the proposal came out. So they're trying to prevent people from dumping everything between September 13th and December 31st, I guess, is the theory.
Yeah, I think that's the main one that had kind of a unique date of a retroactive change for a capital gains increase to.
That's a big deal.
Yeah, September 13th. We're really hopeful that they'll change that to be on a go forward basis. Because you can imagine sort of the nightmare of people who maybe sold stocks, real estate, or crypto, between September 13th and the date that they sign into law, they would kind of be stuck in paying that higher capital gains tax rate. So yeah, and initially in the previous, it wasn't the pre-proposals when they were talking, it was supposed to be higher capital gains rates effective April of 2021 or something like that. So they've delayed that to September 13th, but maybe it'll be delayed even further.
You could have already closed escrow and then found out, oh, I owe a whole bunch more. That
Yeah.
is unbelievable. Okay. Kaaren, in your world, any of that retroactive?
No, not retroactive so much as really being effective December 31st. It's like, for example, being effective December 31st, 2021, or being retroactive to that date. I mean, each one is different, but again, we're talking about proposals here,
Right.
not finished product.
Yeah, I mean, that's the thing, right? If it doesn't come to agreement by the date Congress adjourns, right? You know, it could get pushed into next year theoretically, right? And
And I think one thing that, Kaaren, you probably have more to say on this than I do, with respect to proposed changes to self-directed accounts investing in syndication deals, although the changes are not technically retroactive, but it does impact investors who already have their money in syndicated deals that they might have had the money in there for years, you know, prior to today.
That's true.
Okay. Is all of this coming about because we have to chase a lot more money because of the new types of programs? Is that, like the climate change issues and all that, the $3.5 trillion, is that what a lot of this is for, is trying to raise money and revenue for the government to pull all this off?
Well, in my opinion, it certainly isn't about taxing the rich, because everything I'm seeing is about taxing the middle class. I don't see how this is going to impact the rich if that is, in fact, the goal of Congress.
And I don't think they're calling it the middle class anymore. They're calling it the new definition of wealthy.
It's changed. It's gone down to zero. No,
Right.
right.
But yeah, I mean, presumably it's I guess I'm not a politician, obviously, but presumably it's being done to pay for a bunch of programs. I mean, maybe some of the pandemic stuff. Who knows, right? But they talk, it's supposed to raise trillions of dollars, obviously, right? I mean,
okay.
2.1 trillion in new levies. So
Kaaren, what are we talking about? What changes are they talking about for the retirement fund world?
Well, several, but I think the two biggest would be in sections 138312 and 138314 of the House Ways and Means Committee proposal. And so, you'll find that proposal. You can just email me if you want it. I'll put it here in the chat, and we'll just share it with you.
Okay.
So that you can look at it, because there are a couple things that affect IRAs, but most prominently, what's going to affect self-directed IRAs will be, like Amanda pointed out, that it really does impact people who have, Roth conversions will be impacted. So the bill eliminates Roth conversions for IRAs and employer-sponsored plans. And that's for people with taxable income of $400,000 or married people filing jointly with taxable income over $450,000. So those people will no longer be able to do a Roth conversion. It kind of closes the backdoor Roth, if you will, the one that was created by Congress, by the way, 10 or 11 years ago when they agreed to TIPRA. Also, it's the section is going to prohibit employee after-tax contributions in qualified plans for people that have high incomes, and Matt and Amanda can go deep on that. But what's really at stake here is that you'll no longer be able to invest in certain types of assets that you used to be able to invest in with your self-directed IRA, like any kind of asset where you have to prove your education or your income. So that means no more private placement investing. And as Amanda alluded to, it's not just that you'll no longer be able to invest in this asset class, private placements, which are also called Reg D offerings, Reg ABCD offerings, private equity, lots of different names for the same asset class. But if you have that kind of equity presently in your IRA, you'll have 2 years to remove it from your IRA. And just the flood of unintended consequences or intended consequences, I don't know, will be just tremendous and really devastating. So devastating to the value of retirement accounts. So this is why I've been on a real push with uDirect to get people to write to their congressional representatives, their House representatives, their Senate representatives, and let them know what's actually in this bill. Some of them don't even know. They kind of shoved it in at the last minute. So that's only one of the things at stake, one of the asset classes that's at stake. The other one is the IRA owned LLC. Okay. So there is this, it talks about where you're not going to be able to invest in assets where the IRA owns 10% or more of the company. Well, if you have an IRA owned LLC, you own 100% of the asset. And so that would make the IRA owned LLC just null and void. So just like with private equity, what you'd have to do is get it valuated. At least with the LLC, you can move the assets back into the IRA and you're okay. You don't get taxed.
Exactly.
But for the private placements, if they can't get those, sold or liquidated in some way, it means that middle America will be left holding the bag, paying the tax on the value of their private equity. It's really scary.
Yeah, that is scary. Before I go to Matt and Amanda, are there any changes where they break promises that are like Roth earnings? Any intention to make that taxable?
No, not at this time. What's ironic is I guess it was like 2018. Congress was talking all about everything was about Rothification, and they were looking at this time to make everything a Roth. And so, but then at the last minute, they pulled the reins back on that, and that never happened. So I'm not seeing that at this time.
Okay. I guess part of what's going on is when you make an investment under current rules, there's trust that will continue.
I see what you're saying.
Well,
I see what you're saying.
Right.
Yeah.
I'm just saying, even stuff that you've talked about, people that are going to be forced to sell something they would never be thinking of selling. It bothers me because it breaks down the trust in the system.
It does. When people invested in private placements, they did so legally, with really the encouragement of the federal government with the Jobs Act. Hey, we want you to invest in private equity. We want you to invest in private companies. And we did. And now they're looking to pull the reins back on it. So everyone has to tell their story, tell Congress how this would impact you.
Yeah. And one of the most important impacts is that, wow, I did everything that was legal and I got slammed for it. I don't think that's a price tag that we want America to pay. I don't.
No.
Matt and Amanda, I'm just going to go down through a series of questions because I'm very interested to know what's being proposed in different types of tax. So corporate tax rates are currently what percentage?
They're currently 21%.
And they're talking about that going to what, 29?
They're talking about it changing a little bit. So they're actually talking about bringing the lowest rate down to 18%. And I think that's in income up to 400 grand, if I remember correctly. And then you'd have a rate of still have 21% from 400 grand to $5 million in net profit in the C Corp. And then above 5 million in net profit, I think the tax is 26% is what they're proposing.
Okay.
So it's actually, it kind of depends. For the larger corporations, that'll be a bigger hit because they're going from 21 to 26.5. Most of our clients, in terms of real estate, they have a C Corp for their active business, whether it's flipping, property management, that kind of stuff. Typically, they're under 5 million of net profit or taxable income.
Yeah.
So they'll either stay at 21%, or it might even be better because they might actually get the lower tax rate of 18%. So that one is not as bad of in the proposal in terms of our client profile, at least.
Okay. Capital gain tax rate right now, the max is?
Right now, the max is 20%. Previously, we've heard a lot of talk about having that go up to 39.6% of ordinary rates. So this also a little bit of a good news. It's increasing from 20 to 25%. but not to the 39.6.
Okay. Is that true for every level of earner?
I think what's going to happen is they haven't talked about taking away the 15% capital gains rate as far as everything I've read. So that's still going to be in place. So I think the 25% would kick in going, kind of in that $400,000 to $450,000 of taxable income range that they're talking about throughout their entire proposal. So I think people who, if you have 200 grand of taxable income, then your capital gains will be taxed at 15%. But if it is hovering around the 400 to 450 range, then some or all of it might be taxed at 25% instead.
I thought there was a proposal for if it was over $1 million, that it would, anything above $1 million would be 30.
So that's what they were talking about, over the last year is kind of what they were wanting to do. Like if it was over $1 million, let's tax it at 39.6. That was not on the table in the most recent proposal that came out on the 13th. So, fingers crossed that they're going to keep that off the table.
So yeah, for now that 1 million, 39.6% right now, that seems to have been replaced by taxing, higher income people, the over 400,000 of total income, taxing them from 20% to 25%.
Okay. Does the earning threshold of over $1 million impact any taxes that we're talking about? I just want to know if that's off the table for all asset types.
Yeah, I don't think I saw anything about $1 million in terms of, changing tax rates. I mean, you probably got it on your list to ask, but they're talking about changing the highest marginal tax bracket for individuals.
Right.
Right now it's at 37. They want to move it up to 39.6, which it's a 2.6% increase, right? It's not large, but it's not small, obviously. But the biggest thing there is that they're going to, right now, the highest tax rate of 37% kicks in, for a married couple, somewhere over $600,000 of taxable income.
Okay.
But they're going to start that 39.6 down at like $450,000 of taxable income. So that's the actual biggest impact on that change, is not necessarily the 37 to 39.6. It's when does it start?
That's for sure. That's a big, like Kaaren, you pointed that out. I guess that's not middle America though. That 450 doesn't represent that, but it certainly represents a lot of tax between 450 and 600.
Oh yeah.
Yeah. And, it's interesting too, there's a huge marriage penalty because, one of the promises, right, was no one with 400,000 or less of income will have higher tax rates. Although that's true for single filers, for married couples, it's not 800, right? All the higher tax rates and the takeaway start at 450. And so you see that huge marriage penalty for a married individual is only $50,000.
Only get 50,000 for your spouse.
So,
Right.
Yeah.
Right.
Gotta marry someone with lower income.
Life goals.
That's funny. Okay. I want to get the picture of the worst case scenario, just so I understand. So the top tax rate probably goes to 39.6, but there's an adder of 3.8. Is that correct? After what amount?
So
the 3.8 is there's a net investment tax. That's a tax that's been around for a couple years.
Yes.
And but historically, or under today's law, that is assessed for high income earners on investment income. So examples of investment income are, stock sales, rental real estate, or interest and dividends, right? That type of income. Now the proposal,
all of your clients.
Okay. Now the proposal is to kind of supersize that and make it not applicable just to investment income, but also to business income as well.
Right.
So in the real estate world, think commissions income, fix and flip, active syndication income, property management income, right? Realtor commissions. So that's the new. The proposal's trying. It's not a new. I mean, it's a tax that's been existing, but they're trying to expand the definition of what will be subject to this additional 3.8.
In the real world, it could be CPA firms, it could be self-directed retirement custodian firms, that kind of thing.
Everything Bruce Norris does.
We all own companies and we all have employees. So are there any of the tax changes for, let's say, Medicare and Social Security that we pay our share of for people that work for us? Are those limits being raised?
I didn't see that. And, that again was probably in what's been talked about over the past year as one of the things to be on the table. That was not, as far as I know, didn't come out with the proposal on the 13th. But obviously at 3.8% tax, that was called a Medicare surcharge. It was for, Social Security and Medicare taxes of some kind when they passed, 10 years ago or so. So it's all gonna funnel into that bucket is what I'm assuming, right? Is that it's gonna help keep funding the Social Security deficit, if for lack of a better term, I think.
Okay.
And the income threshold, to answer your question from earlier, the threshold for that is the same, taxable income 400 single or 450 married.
Okay. And they are now taxing Social Security up to what dollar amount of earnings? Or is that Medicare that's higher?
So Medicare is higher. Social Security caps out it's around I think it's just under 140 grand is where you cap out at that.
Okay.
And then Medicare is unlimited. So you could have $1 million W-2 and still be paying Medicare taxes.
Okay. Do the employers share in Medicare or just the Social Security?
Employers share in both.
Yep.
Yeah.
Okay.
I did read in the proposal, good news is there's something about a 50% tax credit for employers who pay for qualified childcare services for employees, that there's some sort of a 50% tax credit. So that's a little bit of good news to share on the proposal.
I'll make a note of that.
Yes.
That's funny.
Pay childcare for your employees.
He's feverishly writing this down.
Is California raising taxes? I'm just curious.
Good one. I haven't really heard anything about it, but
I mean, it's at the highest rate is at over 13% right now in the state of California.
Yeah. So I just wanted to make sure I can do math still.
No, you've got it down. You've got 39.6.
I'm trying to add only 3 figures here. My hand is shaking because I'm not paying my share at about 55%.
What is it that our friend Harry the attorney calls it? He calls it confiscation. Yeah.
Yeah. Well, it's interesting that the narrative that we get told, it was interesting. Aaron and a couple of friends that he's known forever, I've known him forever, and they spent half their weekends literally of their life during junior high and high school. So yeah, we got good rapport and trust there and everything, but their opinion of how things work and what the people that make substantial money is just so different. And when we had a discussion, it was sort of like, we've never even heard of this stuff, like me explaining what it's like to be an entrepreneur and when you have employees, what it is that you pay, all those things. And they were just astonished, thinking.
Did you show them some charts?
No, I didn't, but that it's very deceptive to use percentages.
Right.
Because dollar amounts are actually what's spendable. So you got one really great, go-getter, the amount of that they're paying in their lifetime is astonishing. Just for fun, because I started that conversation started at me thinking, okay, the dreaded 1%ers, how much do they have to be what's their net worth? Do you have any idea?
No.
It's $11 million. How many of your clients are in that room? A lot. When we have the I Survive real estate event, there's a ton of people in there. And what did we do bad? Nothing. All we did is work our butts off, take risk, and hire people. So
yeah, make jobs for other people.
Yeah, and that's the thing when I realized, the 1%er includes almost everybody I know that's successful borrowing our money or lending our money. Wow, you really want to go after that group? All the good they've done for all the people that, have worked for them. And oh my gosh, it just kind of gave me a different take on who they are. Cause I thought, oh, well, maybe they are just the completely elite. And then, you think, no, that includes so many people I know that took the time to get 25 houses and pay them off gradually over a lifetime. That the end result doesn't take 5 minutes. It takes about 40 years, right? Then all of a sudden you hit pay dirt where your debt's finally gone and you don't think you should be demonized for that one. That's for sure. Kaaren, on the changes that are being discussed, are they across the board and things that you can hold in an IRA and a Roth and a 401k? Is that across the board?
They're not. So they don't apply to brick and mortar real estate. It doesn't apply to your IRA lending money, so long as you don't have to be accredited to do that. It doesn't apply to investing in precious metals or limited partnerships or, buying performing and non-performing debt. You can still do all these things. And by the way, one of the things I wanted to add about the proposal for the private equity, to remove private equity, is that after December 31st, 2023, if your IRA holds private equity still, it will cease to be an IRA.
Wow. So that means it becomes immediately taxable.
And if it ceases to be an IRA, that would imply that all the assets in your IRA would be impacted, not just the
Right.
private equity.
Well, that might imply too, I mean, not just taxable, right? But in a typical situation where they blow up somebody's IRA, you've got taxes and penalties.
Correct. And
So if it follows those lines, then.
Right. I don't think that the people that wrote this, I hope, because it seems like it, they really don't know what they're doing.
Yeah.
Because this is bad. And one of the things that we haven't touched on, it's not really my area of expertise, but I do understand the number $80 billion. And that is the number that's in this proposal that's going to go to the IRS so that they can make sure that we're complying. That's going to be so that they can send their IRS down. People after us. So that they can help us voluntarily comply. I think that's how they say it in the bill.
Yeah,
you wrote that down right below the child tax credit thing, right?
Yeah, exactly. Yeah, I was thinking about having some more kids, so that was really exciting.
No, I was thinking what your take is on all the extra money for audits and then the $600 transaction. I don't quite understand. I mean, I understand, like if you go to the bank and say, I'm going to take out 10 grand in cash, I understand you fill out a form, but what's with the $600 transaction?
Well, I'll tell you what I know, and then Matt and Amanda can say what they know. But yeah, if you take out $10,000 from a bank, the bank has to file a SAR, a suspicious activity report. I don't know why it's suspicious, but that's what they have to do, and that's a limit. So now that's going to be $600. Can you imagine how that's going to decimate small banks? Who's got the staff,
right,
to handle that kind of administrative nightmare?
Okay, now you're talking about just getting $600 in cash, or are you talking about a $600 check?
$600 transactions, but they are looking to exempt automatic payroll contributions, or in automatic payroll transactions, which, okay, there's that. I mean, but that probably is like a drop in the ocean.
Wow.
Yeah, I think it's interesting. I think, the proposal to increase audit or IRS enforcement. I think they've done studies that show every dollar that's dedicated to IRS reinforcement collects $4 to $5 in tax revenue, right? So from that perspective, I guess it's good from a revenue raising perspective. Obviously, bad from the CPA taxpayers' perspective because it's a lot of time wasted in dealing with those kinds of inquiries. But nonetheless, I do think they need help because a lot of our clients, and just we're hearing from other CPAs too, is a lot of people are getting these bogus letters that are official from the IRS, but they're just wrong, sending out wrong assessments or claiming returns are filed late when they are not. And the issue becomes we can't contact the IRS because it's taking them forever to process power of attorneys. When the client calls the IRS, they're on hold for hours on end, just looping back and forth with no real resolution. So it's just kind of a, compounding effect of not having resources and not doing a good job, at the IRS.
Yeah. So hopefully some of that money would actually, instead of going to doing audits, would actually go to hiring people to process paperwork and, get through their backlog of things,
Yeah. And get some rebates back to people. What was interesting, this kind of reminds me, Kaaren, what you mentioned about people making decisions when they haven't got a clue about what they're talking about. So when the lending world crashed about 2008 and you had TARP, the TARP document was really long. I read it word for word with a yellow marker. And at the end of it, I realized, okay, to be honest with you, they have no idea what they're going to do with $800 billion.
Yeah.
And when you were discussing things, I would listen to Congress talk about it, and you realize, man, you had better get the best real estate people in the world to give you an idea of what you're about to do is going to be terrible, because, talking about doing it a certain way, well, that may sound good, but in practicality, and it doesn't play out like you think. And that's kind of what you're talking about. You're talking about changing the rules in arrears.
Right.
And
right. And one of the things that'll do is just imagine people who are maybe not 30 years old, but maybe they're in retirement now, and they've invested in private placement and assets, and now they're relying on that money in their retirement to supplement their income. But now they're faced with this huge tax bill because they had to, if they weren't able to liquidate it, then they're going to have to pay tax on it. So there goes their retirement savings, not just the asset that they had, but they're going to have to use their savings to pay the tax. And hopefully that private placement goes well and doesn't, go belly up where they end up with no assets at all. It'll be a fire sale on private equity. And then the asset sponsors, what are they going to do to replace that private equity? They can get it from non-IRA money, but they're going to have to find investors. And so does that mean that private equity is going to be sold pennies on the dollar just so that people can liquidate? And that's going to hurt savers. Like you say, good people who've saved all their lives, worked hard, put dollars away, saved it, invested, and then this is the end result.
Yeah, because think about it. Like, let's say you have a syndication partnership with, 60 investors, got a real estate deal. Maybe 5 of those investors are IRAs. How likely is that real estate syndication partnership going to have enough money to buy out those IRAs, to your point, Kaaren, or they go and say, hey, other 55 investors, would you like to put money in to buy out these investors? Who's going to want to do that necessarily? Maybe some, but not all, right? So it's just it's one thing after the other of the dominoes of, if things don't go the right way.
About 3 months ago, I got a call from Doug Duncan. He said, would you be willing to go to Washington, D.C. and speak to the president of Fannie Mae? And I just thought, okay, of course, that's unbelievable. So I guess I was thinking, Kaaren, somebody like yourself, is there a go-to person that there's like, maybe we could have a sit down? Because the conversation was from me to the president of Fannie Mae was from somebody that has just some street knowledge and how investors work, that type of thing. It was more about that than anything else.
Yes, I sit on the board of directors for the Retirement Industry Trust Association.
Right.
And we are a trade organization and we have a lobby. We have lobbyists. And these are attorneys whose jobs, that's their job. They're registered lobbyists. And they were talking to the House Ways and Means Committee before this proposal was announced. And like just a week before, and then boom, here it comes with these provisions affecting IRAs that the committee said nothing about, gave no indication that these things were going to happen. So that's what happened on September 13th. Then fast forward to last week when we're talking to those lobbyists, in a RETA meeting, and those lobbyists say that they're going to their the congressmen and women, they're going to the staff members, and those people that are making the decisions don't necessarily know that these provisions were stuffed into the bills. I mean, we're making them aware. But yes, we're getting in front of the decision makers, sitting down with them. But a lot of them are really, there's a good Market Watch article I'll share with you, but a lot of them are really digging their heels in and saying, this is the way it's going to be. But I just don't think that they see what's going to happen to people.
It's important for them to even have the capacity to understand what you're talking about, because a lot of the people, I'm trying to think back, what was the company? This was in about 2009. And they had a new platform on how people were making payments. And we interviewed actually the president, and he had a great document that I read word for word. And then I watched Congress interview him, and I realized not one of them read a word of it. Oh. It was so frustrating. And the first thing I asked him was when I did the interview, I said, are you okay? Because it was such a grueling experience, and it was not a reasonable thing to do. In other words, he's president of a company that has this as a product. And it was kind of eye-opening though about grandstanding for political purposes as opposed to actually getting to the bottom and trying to understand something.
Right.
And I guess that's part of it, is that I don't want people to lose faith in the system, and the honesty of it. That's just, Very frustrating. Remember when there was an $8,000 credit if you bought a home in say
First time,
2000 and whatever it was, 9?
Mhm.
So we had fixed a home, and my daughter wasn't ready to buy her first home. So we went into escrow with her, and we applied for her $8,000 rebate, and it was denied because I owned the company that sold her the house. What I thought in my mind was, you just taught my daughter not to trust the United States. That just made me sad. How are your clients? And we all deal with people that have worked hard and done well. What's their perspective on what's going to go next for the country? I'm just curious what the mood is from your perspective and who you talk to.
Gosh, I don't know. I think it's different from client to client. We have clients that are really keep an eye on these things and just calling and emailing, to get updates. And then we have clients who are just kind of like, wait and see. None of this is real yet until it gets signed. But I think a lot of people, I've heard from a couple of people, when, because we did a really brief tax updates and just talking through what are the proposed changes and how it relates to people who are in different types of real estate investments. And a lot of people were thinking, okay, well, this is kind of the worst of it in the proposal. It's only going to get better from these proposed languaging because of negotiation. And it's kind of difficult. I had to tell them, no, that there's no indication that this is the worst of it. The proposed are just the proposed. There are people now who are thinking those are not enough. These are not enough tax increases, and there needs to be more levies, more taxing. And then there are others who say, okay, this is more than we wanted. We need to cut back on these proposals, right? So I think for some reason there's this myth that people are thinking, okay, well, this will be the worst of it. Only gets better from here. I just want to say that's not necessarily going to be the case. Certainly could be, more strict or even more proposals in the end.
Well, certainly more visits from the IRS to people's businesses and personal. They're not going to hire this many people and ignore anything that they think they could get a 4 or 5 times return.
Yeah. I mean, I do think that part of it is going to pass. I think that's, the audit increase enforcement does get a lot of support in Congress from both parties. So we do expect that to pass. But from our end, I don't think that really changes anything because historically speaking, at least for our clients, we always tell them, everything you do, every position you take that with audit risk in mind. So anything you're claiming, it's based on the assumption you can support whatever it is you're claiming, whether it's a receipt, whether it's hours spent in real estate. Because ultimately, who knows who will get audited, right? Although the odds of you being audited are fairly small, nonetheless, if it's your turn or if you happen to be selected, that is what's needed to prove your deduction. And if you can't prove it, then odds are you're going to owe the IRS the taxes plus interest and penalty. So that part doesn't really change in terms of how you should be operating as an investor.
Yeah.
Same as before.
Kaaren, what about you? As far as how your clients are feeling about, what's going on?
We've got a world where a lot of things are happening simultaneously. And with the IRA owned LLC, one of these asset classes that they're looking at really attacking and decimating is that people got into these assets, and it was perfectly okay to do that. And now suddenly their asset is not illegal, but it's, practically they have to get rid of it. So, okay, change the rules. You're right. Maybe somebody who owns private jets doesn't need to have a retirement account or get a tax break for it. I get that, but the middle class sure needs it. And so the people who've played by the rules will definitely be hurt by these proposals.
I guess come down to, I feel like California actually respects occupancy more than ownership. And that's a scary sentence. I think I'm like most investors. Okay, change the rules, fine. As long as I know the rules, I can say I'll make intelligent decisions. It's when they go backwards, when you've already made decisions following the rules, that you get suspicious of making decisions going forward. And that isn't healthy. I mean, I sure hope that people that are going to make these decisions pay attention to people that know, like yourself. I mean, that to me is the best outcome.
what can we do now? We can take action, and we still have some power to do something about these proposals. And that's what I've been pressing, is to, reach out to your congressional representatives. There'll be another RETA meeting, or, where we all get together and talk to our lobbyists on Thursday. So whatever I learn then, I'll bring to the tactics brunch. We're going to, I think, have weekly calls. So I could have new information. I intend to have new information between now and then.
Can you email me a way that we can have people correspond to the people that are, perhaps voting on the legislation, whatever it is that maybe you've prepared something, that's.
I have, and I'll put it here. I will share it with you, and I'm going to put it into the notes right now, the chat, so that you can share it with people. But this gives you a way of, being able to, hang on a second, gives you a way of being able to reach out, like how to reach people. There's a template letter, but use a template letter as a base and as maybe like a structure, but tell your story.
Yes.
If these things, what do you see?
Maybe not in 20 pages, but
No, you can do it in a simple page. But hey, if these pass, this is what I'm faced with. If this passes as written, this is what happens to my business. This is what happens to my investors. This is what happens to the project that I'm putting together. And tell your story, because that's what we can do right now.
Yeah, and I think in addition to that, is the stuff I mentioned, is that, okay, I trusted the process and invested that thusly, and I just got burned for it. Why do you think I'm going to have faith in anything you tell me is okay going forward? That's a bigger price than I think anybody wants to pay.
yeah, and I mean, on our end, I think, hoping by the tactics brunch that we have some more answers as to what these proposals are going to entail. It gives them obviously a few more weeks to do some negotiation. So maybe we'll have some more answers by then.
I think, that's the goal. I mean, we have a draft presentation for the tactics brunch, but I think it'll change. We don't know if it'll change slightly or significantly by the time the brunch occurs. But I think our plan is to focus on what the proposed changes are, but also what are some year-end strategies to consider in light of those. I know every year at the year-end brunch, we talk about year-end strategies. I think this will just be a very important one, especially since most of the proposed changes for next year are tax increases. I think for the listeners between now and then, if you haven't, probably get on your CPA's calendar. I imagine all CPAs will be very busy for year-end planning. So even though you don't know what the changes are, maybe at least pencil yourself on their calendar now, so that by then you can come to our brunch, and then right after you'll be able to meet with your CPA.
Amanda, can't you give somebody a call in Washington, D.C. and, we have this brunch. We'd like all the answers by then. Can we do that?
Exactly. Yeah, exactly.
Don't you know who I am?
That's right.
Brunch is October 30th. It's on a Saturday morning. It's from 8:30 to 12:30. You can go to the norrisgroup.com and sign up there. It's $25. It's a virtual ticket. And for $25 to get the wealth of information and robust protection and everything that you're going to get from this session I don't know how we do it for $25. Let's put it that way.
$25? Who's in charge of this?
Who's this Joey guy that just got on?
And I do want to say, because Harry Barth, right, estate planning attorney, is going to be there. We didn't mention anything about estate taxes, but there are some good news and bad news on the estate planning side. So I know he will have some great things to share that are very timely, that have to be done before the end of the year as well. So since he's not here, I'll speak for him.
Well, I'll be honest with you, what's best thing about this event is I learn every time everybody gets up and speaks. So it's great. I don't sit there and go, yeah, I already know this. I do not sit through that meeting with that attitude, because I'm always taking notes going, I didn't know that.
Yeah, and then I get scared when Bruce takes notes and anticipating questions from Bruce.
About 1031s too, Dino Champagne is going to be talking to us about 1031 exchanges, which we were thinking were going to be just eliminated, but it looks like that's not part of this proposal, right, Amanda?
You just jinxed it.
Yeah, that's the good news is right now under the current proposal, we don't see any changes or mentioning of 1031 exchange. So hopefully it's, stays off the radar between now and the end of the year.
Talk about unintended consequences. So play that out. You've got a 6-month window and then 1031 exchanges are over. What the heck happens in that 6 months? And then what happens to the brokerage world the day after the 6 months? Just says, never mind. I'll keep everything I own till I die. Right. So the brokerage business is going, okay, we don't have anything to sell. That's kind of what you were talking about, Kaaren, is just there's real life impacts that if you don't have enough experience, you think it's, let's do that. But boy, it's not. So
Yeah, we need to make Congress aware of how this is going to impact us.
yes. And I'm glad you mentioned there's just so many people in middle America that would really be impacted negatively, including people that already retired on the income they thought they could count on. I'm hoping that's how we solve most of this stuff, is reasonable people reach across the table and say, yeah, we have our differences, but we've got to land on a square that's best for America. Every time at the Nixon Library, I end that with asking all the panel, what's the one thing they'd like to see happen. And every year for the last 10 or 12 years, I've said I would like every elected official to not act like a Democrat or a Republican, but act like an American. And man, that's to solve a lot of stuff. That really would. Guys, thanks so much for joining us, and look forward to our October meeting.
Thanks, guys.
Thank you.
All
right. Thank you.
Thanks, Kaaren.
Guys, have a great day.
Great to see you.
For more information on hard money loans and upcoming events with the Norris Group, check out thenorrisgroup.com. For information on passive investing with trust deeds, visit tngtrustdeeds.com.
The Norris Group originates and services loans in California and Florida under California DRE License 012-19911, Florida Mortgage Lender License 1577, and NMLS License 1623669. For more information on hard money lending, go to thenorrisgroup.com and click the Hard Money tab.